All right, picking good strike prices for verticals. Oh, that's one of my favorites, man. Picking strikes for verticals. Okay. All right, we've got a few topics over here. Exiting a trade, volatility of the market, swing trading, zero DTE on SPX, and picking strikes for verticals. All right. What else? I think that's it. Okay, cool. So I am going to share my screen here. Best time to take the trade. Best time. Take the trade.
Or the indicators, Eddie. I struggle with, like I've charted it, everything looks good. I'm positive about it. And then I think I hesitate, like I don't hit the gas pedal fast enough. Yeah. By the time I hit it, I've gotten in too late.
Yeah.
Okay. So like what indicators am I truly looking at to say, okay, go?
What you mean by indicators? You're not talking about studies. You're talking about things that tell you when to enter, when to.
Yes.
Okay. All right. Okay. All right. Understood. When to enter. When to enter the trade, which goes along with when to exit the trade.
True. Yes.
Yeah. Kathleen says that, hey, welcome, Kathleen. She's a first timer. Welcome. She's multitasking and she's moving around. She's listening, and she will let us know. I guess she's not able to talk. Okay, that's cool. All right, we've got a pretty nice agenda here, so that's cool. And now is the time when you turn your cameras on, you say hello, and then you can turn them off in a minute or so, if you like, or keep them on. It's up to you. So there we go. Dora, Jackie, Jill. Nice to see you guys. Cloud, man, you made it. Kanisha, you made it. Frank made it. Awesome, guys. This is awesome. All right, I'm going to start sharing my screen here. Over to you. And let's see what we have here. Can you see my screen? What screen do you see, guys? SPX. All right. SPX is great, man. We'll take your money in a heartbeat and then give it back to you and say it's sorry. But it won't give it to you all at the same time. All right. So exiting a trade, first question here. So you heard me say that, or you've had people say that, when you exit a trade is actually more important than when you get into the trade, right? The reason why it's more important is because you're already in the trade. You have to make a decision about whether you're going to make some money or not make some money. Sometimes you don't even have a choice. You just have to take what the market gives you. And now you're in that position where you have to make the decision. If you're in the green, meaning that you're making money, is it good enough? Is it good enough for you to take home, close the trade, close the position? Or is it in the red? Are you losing money? And at which point do you feel the pain? And there's enough pain to say, I'm done with this. I need to get out. Now is a good time, or I can't take it anymore. Doggone it, I'm out. So, when's that time? How do you do that? But I think the question here that the person is asking is not necessarily how to when that time it is to exit the trade. I think the person is also asking mechanically, and correct me if I'm wrong here, mechanically, once you're inside of a trade, how do you get out? How do you close out the trade? And just type in the chat, let me know whether that's my thinking is correct over there. But I think I'll hit those two questions at the same time, right? So let's first talk about when you're in profit. When you're in profit, usually you should have a target, right? You probably enter the trade and you saw the potential and you decided that, you know what, I think I can make $200 on this trade. I can make 100. I can make whatever number it is. What do you do once you reach that point? If you are in a bracket order, you don't have to think about it. So that's answering some of the, one of the questions, that if you entered the trade in a bracket order, right? And what's a bracket order, by the way, guys? A bracket order is that order that you enter where you put in your your order entry, your take profit, and your stop loss all at the same time. That's your bracket order. So when you're in profit and you have, when it reaches that point, let the system take it, do that for you. But if you did not have a bracket order, let's say we are entering these, I'm going to enter a trade here in two ways. There's two ways to do this in thinkorswim, right? Actually, all the platforms that you can think of, there's always going to be more than one way, but let's go with a simple way. So I'm looking at a chart of Apple here. Apple here was, it reached a support level, bounced right off the support level, and, brought the market up here in the afternoon. That's what this is all about over here, right? And we'll talk about that here in a second. We'll see how Apple yesterday pretty much just drove the market, right? Drove the market yesterday. We'll see how that works. So let's assume here that Apple has hit that support level, is going up, and now it's heading for this zone over here. It created a small gap, and let's say we want to capture a few points. I'm just going to go for $1, okay? So the usual way to do it, obviously you'd go out about 45 to 90 days. Just for example, I'm just going to do 6 days, which is November 11. That makes it, I don't know what day of the week that is. But anyhow, you click on the ask column and you choose however many you want to buy, and you click confirm and send, and you push send. Let's go. Maybe I should do these on demand. Let's see whether I can fire up on demand here. That'll make it easy for us to actually demonstrate a live sort of scenario. And while that is firing up, I'll just continue with this. I'll just continue with this demonstration here. Let me log in. Okay. So now that you have that in the system, where do you go see it? Obviously, you go to the Monitor tab. This is where you find all your trades. And you've got 3 sections here. You've got, well, more than 3, but you've got some sections here that are more important than the others. There's the working orders. It's not rocket science. It's exactly what it means. Working, it means that it is in progress. Don't misinterpret it. Don't look for an additional meaning. That's all it means. It's working. Right? Hold your horses. That's what it means. Field orders, you're good to go. Where to field it? It's like going to Dunkin' Donuts and they give you the coffee. At that time, your order has been filled. But when you're waiting for them to make the coffee, your order is in working status, right? Dude, man, it's a Saturday morning. How do I come up with these examples? Maybe I need coffee. Maybe I think that's what's on my mind.
Yeah.
Yeah. But that's a good one. I didn't even think about that. I didn't prepare that. It wasn't on my notes. I was totally unscripted, but I like it. It works. So once it is in working orders, then what happens? Once it gets filled, it goes into the field orders. And if you cancel the order for any reason, then it will go into the canceled orders. Right? Pretty simple stuff. If you had a bracket order, it is. Sorry, if you entered it just the way we did, it's only going to go in the field orders, and there's nothing else in the working orders. So to close these orders, since you did not originally send a closing order, then to close it, you have to come down here to the position statement and close it from here, right? By right-clicking, and at that time, you will have the opportunity to create a closing order. Let me see whether I can simulate that in on demand. I'm going to bring up on demand here in a second. We're in the month of November, so let's see. November the 5th. How about we go Tuesday? Okay. All right, let me bring up my on-demand here. So I've got on-demand rolling here, and I'm going to push that demonstration one more time. This time I'm looking at Apple, and I'm on the, it looks like it's going down. So let's do a put example, right? We're going to buy a put going down, and we're going to do 3 DTE for November the 4th. And this will be a nice demonstration here. So I'm just going to buy one Apple here for 3. It's going down here. And I got filled at 318. So let's demonstrate how do we close these order, because we did not enter it into a bracket order. All we did was just buy just bought the stock, right? I mean, the option, the contract. And now we want to figure out how to close it. So remember what we said, once it leaves the working orders, it goes into the field orders. By the way, that's just for today. If you carry it over tomorrow, if you come back tomorrow and you're still in the trade, it is not going to be in the field orders. You're not going to see it there. So the question is, where is it? Right? Where is it? Instead, it's going to be down here under the position statement. This is where you look for it. So right now we're negative 50 cents, nothing to worry about. We're up $4.50. Say you decide, that was your goal. Oh, by the way, if that was your goal, you need new goals, right? You really need new goals. And you want to close the profit right now. So what do? You simply right click on your order, create closing order, and you sell. And once you click on that, notice that it gives you a price. This is the current price. If you want to lock this price in, you can push the padlock. Or if you really don't care, you want the best price at the moment, then all you have to do is confirm and send, and thinkorswim will give you the best price. Will give the best price. But what if you already had calculated your profit? Maybe you decided, when it reaches $5, that is when I want the system to sell. In that case, you can simply put in $5, right? 5.00 and push confirm and send. Look at this. It is going to sell at $5. Okay, so now guess where that order is? That order is in our working orders. And in fact, if you go to the chart, you can see that this is represented down here, that once this order reaches approximately 148.5, just going to estimate that it is going to sell. But what if you decide, I don't want to wait for it. I think it's pulling back. Maybe you've been in this a long time, or some news just came out. You want to close it. The way to do that is go back to your monitors tab and notice that you've got the sell in the working orders here. This time, instead of clicking cancel, or rather create closing order, what you want to do is you want to right click on this working order, do a cancel replace, and you can change the price, or you can open this padlock and decide to take profit now. Go. We just sold it at 342. Does that answer your question?
Yes.
Mary?
Thank you so much. You're awesome. Yeah.
You're welcome. All right.
Do you do the stop loss the same way?
Yes. So let's do one with a stop loss. So let's enter the same thing, and I'm going to enter this time with a bracket order. So here's what I'm going to do. I'm going to right click buy custom with OCO bracket, right? OCO stands for order cancels order, or one cancels the other, however way you want to look at it. And by default, thinkorswim is going to give you a profit of $1 and a stop loss of 1. And you can tell it exactly what you want. In fact, you can tell it that, I want to plus $3, meaning that whatever price you get me in at, go ahead and give me $3 on that. And of course, stop me out if I lose $1. So let's see how that works. So once again, we got filled in at 3.53 here, right? We're just playing here, right? And where are these orders? I'm expecting 2 orders now when I go to the monitor tab, my take profit and my stop loss. So let's see what we have. In fact, we do have 2 working orders. And notice that there's a link, there's a chain link on the left side. If you can see the left side of my screen here, that these 2 orders are linked. This means that they're mutually exclusive. Only one can happen. If the first one takes place, the second one will be canceled, and vice versa. Notice that one is your stop loss and the other one is your take profit. So at the moment, I am $9.50 up, and I decide, you know what, I'm good enough with, okay, it's up to $12. I want to close my order now. What do? Again, same story. I just need to right click, do a cancel replace, open up this padlock, confirm and send. Bada bing, bada boom. I've sold it for $377. I made another $10. Let's see what happens in the monitor section. That order was canceled. What order was canceled? The bracket order. You don't have to think about it anymore. It cancels it for you. Mary, does that help?
Yes, I do have a question because I did exactly that. What makes it not get filled?
What is what?
What makes it not get filled?
If you put in a ridiculous price, it will not get filled. Ridiculous is something like, say it's trading for $377 and you put in like $5, right? Until price reaches that 5, it won't happen because you've told it that I want the price, this is how much I want to sell it for or close it for. So that's what I mean. But if you put a dollar amount in there that is not, what is the right word? That's not what the market is offering.
Yeah,
okay?
But it was actually offering the same exact amount.
Okay, so you're probably talking about a vertical, is that right? Yeah, so with a vertical, there's 2 prices, there's several prices in play. So let's do an example here. So again, we're going to go here, push on ask. I'm pushing on ask because I know that Apple is going down at this particular moment in time. So you've got a mid and you have a natural price. The market and the PL calculation works on the natural price. So if the natural price in the market has not been reached, it is unlikely that your order is going to be filled unless there is enough volatility that you will get a hit almost right away. So 2 things could have been happening. Number 1, your natural price had not been achieved. That's the most likely case. And then the second situation is that you were trying to sell or close the position during a time of low volatility.
Yeah, the second one.
The second one. So let's consider what low volatility means, right? So we know that when you're entering a debit spread, and I think you're referring to a debit spread, we enter during low volatility. That's when you want to buy and you want to sell or set your order to trigger during times of high volatility. So when you have high volatility, then you have an advantage. I'm going to go to one of the stocks here that has a high liquidity, SPX, for instance. I'm going to go to the trade. I'm going to push maybe 7 days out. I'm going to go to spread vertical. And I know I'm probably going ahead here on many things, but let's take, for instance, you're expecting that the price is going to, on this day, it is rising. It looks like it's rising, right? So let's say that you decide to do a call debit spread. Notice that you've got a huge bid ask spread. You see that? 170 to 290. So the middle is where you would expect that if you were buying a debit spread, that you would be, you'd get your price, right?
Yeah.
During times of high volatility and you're trying to buy, there's a chance that you can get in on the low end or on the high end. So if I push 390, for instance, it calculates for me the median price, which is $240, the natural price, which is $4. If I'm trying to get out, this is the price that I will more than likely execute at. If I'm trying to get in, also, this is the price that I'm likely to get in at. But if it's high volatility, did I say low volatility or high? Well, if it's low volatility, I get to pick, right? Because people are trying to sell and they're desperate. But when you're trying to close the position, you want when the market is highly volatile in the morning, first 1 hour, and during the last hour of the day. So I think you also answered your own question there. The high volatility is what was happening, right?
Yeah.
All right, cool. There. Is there a way to place a stop loss after your order has been filled? Yeah, there is a way. You can do that. Somebody's asking here if there's a way to set a stop loss after the order has been filled, and we can demonstrate that also. I think I'll answer that and then move on to the next question. Mary, are you good?
Yes, thank you so much. Appreciate you.
You're welcome. So let's show the person who has that question how to place a stop. So I'm going to go back here to my I'm going to go back here to Apple, and I'm going to place I'm going to buy a put, right? Because this thing has changed direction, but I'm going to buy a put. I'm trading against the market here now for demonstration. So let's continue with that. November 11, we're going to buy that 150. We don't like the ones with the decimal. We're going to buy the 155, right? And she's asking, or he's asking, that if they buy that, let's say at 620, we bought the put. And if we go now to our monitor, I'm going to close these because it's too much noise. We're running negative, right? We're running negative over here, and we're trying to figure out, what can we do, right? Can we put a stop after we've entered the trade? And the answer is yes, right? The answer is yes, we can do that. So first, you have to know how much you bought it for. Obviously, you can go to your field orders and you see that you bought these for $6.20, and you decide you're going to put a stop loss of $5, right? You're going to put, because you want to walk away. You don't know whether this is going to work or not, but you want to put a stop loss of $5, and you did not originally enter this order as a bracket. That's the conundrum. That's what we're trying to solve here. So again, all you have to do is simply right click, create closing order as though you're going to sell it, right? As though you're going to sell it, but this time you are going to put stop. Notice that its original limit, you're simply going to choose stop. And you're going to choose the price, and you're going to say that at $5, I will have felt so much pain. Dude, man, I want this thing to just end right now. Confirm and send, sell these for $5. This is a stop order, STP. And these guys are creative, man. I wouldn't have thought of that. Never thought of that. Yeah. So hopefully that answers your question about how to set a stop loss after you've entered an order, a single order that you did not originally have a stop loss. Does that answer your question there?
Yes, it does. It does. Thank you.
Awesome. You're awesome. And you can put in a take profit after you've put in an order. So you're good. All right. So yes. I'm going to go ahead and actually I'm not going to cancel replace. I'm simply going to, let it ride. How about that? We'll let it ride for that. Okay, let's go to the next question here. Volatility of the market. Let me remember what this person was talking about. This person was wondering, how do you trade when the market is so volatile? Dude, you got me on that one. Just kidding. Let's see. When the market is volatile, it offers opportunities. I love volatility. So let's talk about what that means. They are most likely trading S&P 500. So when the market is volatile, it means that you've got wide swings. This is not a volatile day over here. It's not very volatile. This over here is showing some signs of volatility. When you see those long candles, the red candles, green candles, that's signifying that quite a bit is moving. And that is when you make money. Notice I'm on the 15-minute chart. Now, to do your charts properly, you actually need to be on the 1 minute chart. So, did I say 1 minute? On the daily chart. Clear the drawing set here. There's something blocking my screen here. Yes, there we go. All right. So you've got your daily chart here. That's where you want to plot. This is where you want to do all your planning, right? So volatility is important when you're day trading, and also when you're trying to buy something for the long term. Then volatility is also an important factor. So we'll talk about both of those cases. Let's talk about the easy one first. The easy one first is when you're trying to buy for the longer term. Longer term here means not just today, but several days out, several months out. Then you want volatility to be low. Okay. Why is that important? It's important because volatility directly relates, or the price of the premiums relates directly to the volatility. So if I was going to buy Apple today or on this particular day, then if I go here to the options chain, I notice that let's say I want to buy let's do something like I want to buy 15 September 2023. That's 318 days away. Okay, it's 318 days away, and I decide that I want to buy the 150 contract right now, trading for $22.35 on this particular date that we are looking at, which was a few days ago. It was trading at $22.50. So if the market is highly volatile, then you're paying a whole lot more than you should. Because when the volatility decreases or crashes, something called IV crash, then that's 22.50. Even if the 150 strike is still at the money, that premium will be much, much lower. So let's actually think, let's actually look, let's see here. I'm going to see what it's trading at right now. This is the 150 strike. And I want to see what it is trading at. This is Apple. I'm going to go to trade. I'm on simulated trading. And I'm going to go to 15 September. We're looking at the 150 strike. So the 150 strike, notice that it is now at $16.95 today, right? How do I know that? It's because I'm looking at today's prices. I'm back to my sim account, and if I go to the live, this should collaborate. It's now at $16.95. But 4 days ago, this same 150 strike was trading at $22. Okay, it was trading at $22. Let's look at the relationship here first, see what's happening. The VIX, as of yesterday or as of today, right now, it's at 24.55. 24.55, right? Okay. 4 days ago, I'm now looking at November 1 on my on-demand. 4 days ago, it was trading at 22.50, the same strike, and the VIX was at 26, which is about $2 more than today. You can see that there's a direct relationship here between the volatility and the premium. Same strike, same date, same expiration, right? So for a longer term period, you want the volatility to come down. Best time is between 20 and 22 on the VIX. Then you can buy for the longer time, right? Just in 4 days, if you had bought this 150, you would have been down roughly $500. Is that right? Even if your thesis is still good, that Apple is going to increase to maybe 180 or something like that, you'd have been negative at this moment about $500, which is very, very discouraging. I mean, buy something and then within 4 days you're down 400. Not a good deal, right? Not a good deal. So wait for volatility. So that was the easy case. The other case is when you're day trading, then you want volatility to be with you, because the prices are moving, right? Prices are moving. So let's go back here to S&P 500. And I'm going to use simulated trading over here so that I can show you yesterday's chart. Yesterday was an interesting day. A lot of volatility. I'm going to go down here to the 15-minute, and we had a lot of ups and downs. So this is Friday, which starts over here. We gapped upwards a little bit, came all the way down, filled the gap, continued going back down, all the way down here too, and then came back up. There are a lot of hearts that were broken over here when this came down, fill the gap. If you did not come back up, then you pretty much give back that money before it started coming back down. So you have to take profit when you see it. So hopefully, I don't know whether, I feel as though I partially answered that question, but whoever asked it, is that helping? Does that make sense about that volatility question you had? To tell me, because let's hit it a little harder if we need to. Who asked the question? I don't remember who asked the question. Okay, well, okay, we'll move on. Swing trading. Somebody wants to figure out, is it better to do swing trading or is it better to do zero DTE? And my answer to that is, you really shouldn't be doing zero DTE if what? If you don't have enough experience. It's a way to burn cash. Don't do it. So there are a lot of people who do zero DTE, mostly for credit spreads and also just straight calls and puts, and some people also do, I guess debit spreads. You can do a lot of stuff on zero DTE, but you have to understand that when you do zero DTE trades, then you're introducing risk. Just in case we have some new people, people who are listening to this for the very, very first time, and they're wondering what exactly is he talking about? Zero DTE, what's that? So let me break it down a little bit more for the audience, since this is a public session. Zero DTE stands for days to expiration, and we're talking about options. Options have an expiration date. They're not a store of value. You cannot buy an options contract and hold it for 10 years. It's not like buying, one share of Apple and you can hold it for as long as you want. You can give it to your neighbor, your children, your charity, whatever, right? With options, even though you can transfer them to other parties, you can't hold them for a long time. They lose value every single day, every single minute, holidays included. So they're not a store of value, and so that's why they have an expiration date. It's a contract. Every time you have a contract, you've got two dates: the day that it is signed or it is written, and the day that it expires. And in between that time, that is when you can trade it, and it changes value. So when we say zero, it means that it is expiring today, right? It means that it's expiring today. If the contract expires tomorrow, then that's considered a 1 DTE. We say DTE in terms of the number of days. So that's what that means. And just to demonstrate that, if I were to open the options chain, just to give you a better context, then you notice that these dates over here are the days of expiration, and the number in parentheses is telling you how many days to expiration. Hopefully that helps somebody who's new at this, okay? So the caller is asking, do they do swing trading or do they do day trading on SPX? Swing trading refers to when you buy a contract or you enter a position today and you exit maybe tomorrow, the day after, or next week or something like that. Versus day trading, where you're expecting to enter the trade today and exit today. So your question here, I think, is with the way that today's market is working and the volatility, I think that's where that person was going, and the volatility, do we still do 0 DTE on SPX? So I'm going to say yes and no, right? The reason that that's a yes and no is because there are strategies, there are specific strategies that you can use for 0 DTE very, very, very effectively and do it safely at the same time, right? Why are you talking about safety? I mean, we thought trading was just trading. You know, what's all this about safety? Safety refers to risk, right? How much money are you risking? Can you lose money? Yes. How much? That's the safety point, right? So we want to trade with a low level of risk. You cannot use those words in the same day, in the same sentence as 0 DTE. You've eliminated safety, right? You've got 6.5 hours to trade from 9:30 to 4 o'clock. That's all you got when you have 0 DTE. So you need to know what your strategy is. You need to be in tune with it. So let's talk about that. What kind of strategies can you trade with 0 DTE, and when do you enter the trade? With a specific reference to the S&P 500, also known as the SPX, Sugar Papa X-ray. Right? So with day trading, SPX, most people are buying calls and puts, right? You see the market going up, you buy a call. You see the market going down, you buy a put, right? And they're more than likely on the 15 or the 5 minute or the 1 minute. If you're on the 1 minute, we need to talk. We need to have a long conversation and get you, get you right. But yeah, the 15 minute is the best strategy if you're doing a day trading on SPX or most things. I think that for most people, day trading is not a good answer. The reason I think so is because, for one, I've done it for a long time, and I know that the best success that I have had is when I have had small, consistent gains. With day trading, you have a tendency to win big. You also have a tendency to lose big. So it doesn't make so much sense to be up $1,000, $2,000 a day, or in the morning, and then in the afternoon you're down 3,000. Then by the end of the day, you're simply up like $200-300, or just break even or slightly loss. Not a good day. That's bad. So if you're day trading, you need a strategy that is paying you consistently, and then you stay out of the market. Right. So we talk about that in Options with Eddie program, which is an 8-week program. And we have a ton of successful people there who are now making thousands every day. Live, thousands. Not 1,000 in a day, it's thousands every day. That's right. And they're doing it successfully. More importantly, they are keeping that money. And that's the other part of it. Because all of you here know how to trade. Question is, do you know how to keep that money? And that's when it comes to day trading, that's the most important thing. So I would say that regardless of whether you're doing swing trading and day trading, but right now we're talking about day trading, you need a risk management plan that will allow you to reap the harvest on whatever strategy you're taking, but also protect. So here's clue number one, or rule number one, when somebody asks me whether they should day trade. Look at your risk. Okay, that's number one. Look at your risk and decide that if I am going to go into SPX on Monday morning and I'm going to buy a call for $1,880, I need to be prepared to lose $1,880. Can we agree on that? You guys can unmute, you can type on the chat, but we need to agree that that is your max loss. Can we agree on that? That is your max loss. $1,880 is your max loss if you buy that call for $1,880. You need to be in tune with the fact that you can lose $1,880. What kind of things can cause you to lose $1,880? You can lose your internet connection. You can freeze when it comes time to closing your trade. let me look at your faces. Looking at these faces, all you guys are strong. Nobody has ever frozen. I bet you guys are so strong, man. Yeah, you guys have never frozen, right? No? Nah. We freeze. When you enter a live trade on SPX, in fact, if you're wearing your Apple Watch, immediately you can see your heart rate just go up, right? And when you're losing money, your heart rate goes up and your brain stops working. Those two things happen at the same time. You've got a high heart rate, your blood pressure is up, and your brain just says, man, I can't handle this. It's shutting down. It's protecting itself. Anybody ever felt like that or experienced that?
Yeah.
No? Yes? No? Maybe? Okay. All right. That's cool. Yeah. So the deal here is that you can lose, even the strongest of people. Let me fix my, why my videos like this? Where's my video like this? None. There we go. All right. Yeah. So that's a better video. There we go. You can lose that 1,800, but if you have a bracket order, then you have a stop loss somewhere that says that maybe if I lose $350, $300, $500, then that's okay, right? So that's the thing that you have to understand, that when you spend $1,800, how much of that are you willing to risk? What is that stopping point? And it needs to be mechanical. It needs to be non-emotional. You need to decide that if I lose $500 on this money, on this trade, that's it, right? The value of that contract cannot go down to 1,380 and then it goes to 1,350 and you're still debating that you're close enough to your $500. Should you get out now or not? That should not be a debate that you want to have. You can't have that debate. We're not going to have that debate. It needs to be mechanical, that if the price goes down by, for instance, if your stop loss is $5, right? Then it needs to be that if price touches 1,380, you are out. Here's how you can help. You can help yourself by going in every time with a stop loss. You've got to do that. If you don't have a stop loss, then you're setting yourself up for debate. So let's do that. How do we do that? We simply right click on this order. First we need to save this into an OCO bracket, right? So I'm simply going to change from advanced order to fast triggers OCO. And I'm going to right click anywhere on this green line. I'm simply going to right click and I'm going to create the opposite order. Why the opposite order? Remember, this order here is to enter the trade. To close it, we must do the opposite of what we're doing to enter the trade. So I'm just going to create opposite order. Notice that it's now a sell. What we were buying is now a sell, right? And we need to put in a price over here. Okay. And we're going to put in, actually, we're just going to make these a stop. How about that? Just put in a stop and decide that I am going to stop myself out at $15. And you know what? That's a lot of money. Now let's go with $16. How about that? We're risking $280. Does anybody understand how we calculated that? 18 minus 16 is 18.8 minus 16 is 2.8, right? And we know that $1 in premium is equivalent to $100 in real money. So $2.80 is actually $280. Again, I'm dumbing this down. I'm speaking to the new folks that might be listening in. I'm going to try and break down this jargon a little bit. And also for the people who've been around a long time, if you hear me say something that you don't understand, by all means, please stop me and let me explain. I'll be happy to explain. So let's continue talking about this day trading. So you need that stop loss. And if you have that, I'm cool with you day trading. I'm totally cool. It's all right. I mean, how else are you going to make this money, right? There's a bunch of ways that you can make this money, and this is one of the ways. And to blatantly tell you don't day trade and not give you a good alternative, when you know that there's millions of other people day trading, you just need to be a smarter day trader. And the smartest traders are not the ones who make the most money. The smartest day traders or the smartest traders are the ones who protect their capital and the investments and do proper risk management. That is the description of smart, right? It's not how much money you make. If somebody calls and tells you, man, I made $5,000 and they did not have a stop loss, they're just lucky. That's what they are. And they need to call you every day and give you the results. And when they don't call you for a few days, you know what's happening, right? Yeah, they give back. They give it back. So the risk management is important. If you're going to do day trading, make sure you have a stop loss, make sure it's mechanical, so that when that price reaches that $16, there's no debate. The system takes you out. Are we good on that? I think we're good on that.
I have a quick question.
Yes, ma'am.
I put a trade in the other day and I put my stop loss, but it did not stop me like at my number. I think it pushed it back a little bit. How's that? Like it was like 250, but I think it got me at like 257 or something.
Okay. All right. Good question. So here's the deal. When you put in a stop loss, let's understand how this works, right? When you put in a stop loss, you're telling the system that, and I'm going to use this example here to answer your question. This is a market order. I'm telling the system I want to get in at about 1880. Actually, I'm going to unlock this padlock here, and I'm going to tell it this is a limit order. So please, Mr. Thinkorswim, fill my order at $18.80 or better. Better means lower than 1880. Also, Mr. Thinkorswim, if the price drops to $16, that is way too much pain. Please sell it at the market. Tell whoever's willing to buy this 37.70 call, just take it from me. Here, go for it. I don't care what price you sell it for. That's what you're telling it. You understand that? That's a market order. It means that it's not necessarily going to sell for $16. It could sell for $15. It could also sell for $17. It could also sell for $1. You with me? But the most likely thing is it's going to sell for somewhere around 16. Somewhere around 16. It may sell it at 16 or maybe 15.70, because remember, two things have to happen. First, the price has to reach here, then the trigger has to happen. And once the trigger happens, is that you've sent in a market order at $16 and you've told the system, go ahead and sell this to the highest bidder or to any bidder, anybody willing to buy this, go ahead and take it. Now, if you wanted some control, which I think is where you wanted, right? If you want some control, then what you need is a stop limit. So let's talk about that. A stop limit is the next one down, which is here, stop limit. Do you see that? So stop limit says, I need to stop at 16, but I want to be sold at no less than 15.8. Does that help?
Okay.
So you're saying that at 16, go ahead and trigger my limit for 1580. And the system will try and get you 1580 or better, but not lower. That gives you better control, doesn't it?
Yes.
However, there's a catch. There's a catch. What if the price has fallen way past 1580? Is your order going to be closed out? Why not?
Because already past it.
Because you told it 1580 or better, right? You're no longer better. So you stand the risk now of that order staying in the system and you losing more money, well, you could have just accepted and said, you know what, at $16, just go ahead and sell the darn thing.
Okay.
You with me?
Yes.
So stop limit is great in a low volatile environment, but in a high volatile environment, you more than likely want stop. You do not want stop limit. So there's
Okay.
advantages and disadvantages to both. If you're doing SPX, do stop.
Okay.
If you're doing Apple or something that doesn't move as fast, or something else, then stop limit is great because you have a lot of control. Usually with SPX, the reason I say go for stop, just sell it at any price, is because this is your pain point. If this is too much, right? If this stop is too much to lose, then maybe you need a bigger, a smaller stop loss. Maybe you need to stop at 17.
Right.
Does that make sense?
Yes.
Yeah, maybe you need to
So
stop
you
at
give
17.
yourself a little buffer.
Exactly.
Okay.
You get some room, and you know that at $500, that's the most I'm willing to risk on this, right? $500, but you don't want really to lose 500. So you can say that 18 minus 4, maybe go 16. That's $2, and from there you don't have to go all the way to $400 to say that, dude, this thing is wrong, man. It's wrong. So do that calculation. Does that help?
Yes.
Right. That was a good question on that.
And while you're there, I have a quick question. When you look at the change, sometimes it says weekly, and then sometimes it doesn't say anything. When it says weekly, what that really mean? Like if you buy a contract for the weekly, what that imply?
How many times do you have your birthday, by the way, every year?
Say it again.
How many times do you have your birthday every year?
Once a year.
So we could say that your birthday occurs yearly. Is that right?
Yes.
What do you think something that happens weekly happens? Every week.
It expires every week.
Exactly. That's it's as simple as that. So this happens on Mondays. This happens on Wednesdays, Tuesdays, Thursdays, and so on and so forth. It repeats every week. That's why it's called a weekly. It's kind of setting up a recurring weekly event. We meet bi-weekly on Saturdays. Means it repeats every 2 weeks. We meet once a month, so it's called a monthly, right? We meet every quarter. So December 30 is a quarterly expiration date, last Friday of the quarter, right? How about the ones that say AM? Do they expire every morning? No. They happen once a month, but they expire in the morning. So let me explain why the expiration on the 18th is the 13 DTE, and it is also a 12 DTE. That doesn't make sense, does it? Is it a typo or what? It is not a typo. 13 DTE is the regular expiration date. So from today to November 18 is 13 days. And then the previous one, that is 18 November, which is also, well, I guess also 18 November. The reason it is 12 days is because it expires on the day before. It expires on November 17, but it gets settled on November 18 in the morning. So it's a morning expiration date. That was a small tutorial on the options chain for expiration dates. So when you see an AM expiration, then you know that the contract actually expires the day before, and there's some special rules about that AM expiration. This one actually expires November 17 at 4:15 p.m., not even 4 o'clock. It expires at 4:15 p.m., meaning that it gets traded up until 4:15. You can put an order at 4:05 p.m. on a morning expiration and be filled. You with me over there? That was Ajur, right?
Yes, I guess the question, what I was trying to say is, let's say I buy a contract for November 8th on a weekly. Does that mean that if November 8th don't hit, I can sell my contract? I guess that was my question.
Oh, no.
Okay.
Yeah, the answer, okay. I guess I went too far. All right, the basics. Once you buy a contract, regardless of when it expires, you can close it at any time.
Okay, got it.
Anytime. It doesn't matter. So it doesn't mean that if you buy this November 10 weekly for that is expiring in 5 days, that you can't close it before November 10. So again, that's a newbie question here. So a lot of people might be mistaken that if they buy a 60-day contract, that they have to be in the contract for 60 days. No, right? And that's an important point, because a lot of people don't understand that, when they're starting out contracts with options, that if you buy a 30-day contract, you're not obligated to be in that contract. Remember, you have the right, but not the obligation. Actually, in fact, you can close it even if you sell the contract. You can close the position at any time. So think about zero DTE. People get into the trade, and 10 seconds later, they're out of the trade. Yeah, that's a day trade. So the answer to your question is no, you're not restricted to waiting a whole week. I went down the wrong path on that. So, but to finish my thought on the AM contract, my advice is don't trade the ones that have AM with it. Right? Trade the regular expiration, because this is a confusing contract. It also has low volatility. Right? There is lower liquidity. Not low volatility, but lower liquidity. It has lower liquidity than the regular expiration. So if you go in here and maybe even look at the open interest, let's go ahead and customize these. I wonder if there's open interest on these guys. Okay, I'm going to add open interest. You will notice that there's a difference in the open interest for the morning expirations versus the ones with the regular expirations. Looking at the 3750 strike here, 3750 has an open interest of 674, open interest on the morning at 10,690. I believe this liquidity here is very, very different. These are mostly brokerages and hedge funds and all this kind of people, institutions. They like to trade these monthly expirations. They have more control on those. Okay, so go ahead and trade the ones with the regular expiration. Sounds good. They might even be a little cheaper. I'm seeing that the 3750 here is selling for 81.20, and the 3750 is selling for also 83.60 on the regular expiration. But that's no reason to trade this morning. Stay away from the morning expirations. Okay. Customize these. I don't need open interests. Okay, let's move right along. Did that answer your question about swing trading and zero DT, whoever asked that? So if you're doing swing trading, you're on the right path. Go for small, consistent weekly gains or daily gains. That's my preferred way of trading, right? Trade small, trade often, manage risk very, very tightly. Try and make it as mechanical as possible. Yeah. All right. Yep. That's a great comment there, Lindell. Yes, you want to be smart, Janae. Smart is risk management. You know, people who manage risk, those are the people making money. All right. Let's see. Picking strikes for verticals. Okay. Well, let's talk about that. So today's a Q&A kind of thing, right? What would you have done yesterday? And the better question is, what did I do yesterday? Yesterday, I traded spreads. I traded 2 credit spreads, and I was at the money. I was deep. Actually, yeah, I was at the money. So here's what I did yesterday. In the morning, as this was coming down, I got into the 37.30, 37.25. That was not even in the gap, I think. Go to the 15, maybe go to the 1, I think. I was playing with fire. I was playing deep with fire yesterday. This is not going far enough. Let me see whether I can see it on TradingView. Yep, let's try this. So this is TradingView. I'm going to put a commercial in here for TradingView. By the way, you guys, if you do TradingView, right around Thanksgiving, which is this month in the US, they always have some sort of promotion where you can get some money, right? They always have some promotion that that pays well. So so let's see. So yesterday we opened up, came back down, and I believe I bought the 37.30, 37.25, and guess how much I got that one for? Anybody guess? I got it for $2.50, right? But for $2.50, it was basically no loss situation. I was in for $2.50, no stop loss. My max loss, $2.50. It means that if it expired in the money, I would lose $2.50. Simply give back how much they gave me. It was a win-win situation for me. Luckily for me, somewhere around here, it went up and I was able to get rid of it for 60 cents. So that's good. I sold the vertical yesterday. I did a put credit spread. My thesis was that we were not going to go below the closing. I was wrong. We did go below the closing, but did I care? No, because I was already out. Right? I saw this fail. When we tried to fill the gap and we failed, that was my signal that we're going to go back up. Maybe we're going to try and come back and fill the gap. But at this point, I had no idea that all of this was going to happen. All I knew is that we had failed to fill the gap at this point. And because we failed to fill this gap, then my thesis was the price is going up. So the question here is, where do you pick the strikes? Let's first talk about the rules for credit spread, because this question is regarding credit spreads. Credit spreads are that situation where you sell premium. You're getting paid to get into the trade, right? And the thesis here is that you're selling premium, you're selecting strikes where price is not going to go. Or that's one way of putting it. The other way of saying is that you're selecting a strike where you believe that price is either going to push upwards from that point and remain upwards, or you're selecting a strike where price is going to trend below, right, and stay below a certain point. A CCS would have been great. However, when we opened in the morning yesterday, let's see what the difference here is. When we opened in a pre-market, I want to show you some things that I normally do. These are some of my secrets that I'm now spilling the beans here. I'm going to show you. Hopefully you can see this picture. Can you see this picture? Yes, no, maybe? Let me look at the chat. Where's my chat? Yes. Okay, you can see my picture, right? So every morning, as part of my daily routine before I enter the market, I take a snapshot of how the market looks like before it opens. And yesterday, before it opened, the futures were registering plus 55. That doesn't mean that it's going to be green all day long. It just means that we're going to open upwards. So that was my strong indication for a PCS. So here's the rule when you're doing a credit spread. When the market is moving up, or the price or the security that you're trading is trending upwards, what do? You sell a put credit spread, PCS. PCS is a bullish strategy. You're saying that price is going to remain at or above a certain point. So when we tried to fill the gap over here and we failed, that was my signal. That I could safely do a PCS. When you do a PCS, you want to do it below the gap. I was a little bit bullish because we had failed and I was looking at premium that was actually inside the gap. So this was a risky trade. I didn't even tell my people what I'm doing, right? But I've been in this, a little bit longer, and I had my risk management in place. And besides, I was getting it at $2.50. That was absolutely no risk to me. That's called a no risk trade, right? So this was a perfect trade for me. I loved it. In fact, I was kicking myself when it went all the way down to almost 10 cents. I was like, man, I should probably just let it, go to expiration. But then I had already sold it at bought it back at 60 cents. Fast forward, but maybe 1 hour later, what happens? Price starts coming back down. And now I am jumping up and down, knowing full well that, guess what? If I had not sold that thing, it would now be trading at $3, because when the price came down, it was at maximum capacity. It was trading at $4. So I was like, good job, good job. What did I do? I sold another one, this time a little bit lower. My heart was pumping over here. Whew, dude, man. It was pumping, and I don't know why, because I sold the damn thing for another $2.50. Another $2.50. My thesis being that price was going to go up. I can't discuss much more than that, but that was, I talked to a few people. I think, do I see any of them here? Maybe not. But we were looking for market on close high. Market on close high means that at the end of the day, we should see a run up, and it did happen, but I did not take advantage of it. I was already tired by that time. So let's answer the question: where do you pick the strikes for verticals? If you're expecting price to trend upwards, then you select your strikes below, preferably below the gap, if there was a gap, right? And you can see that there was a small gap over here that was opened up yesterday. So let me go here to the, no, this is not going to help. Let's see what's going to help. What's going to help is if I go to my thinkorswim and look at tomorrow's, let me go back here to the 15-minute. Let's try and decipher this. I'm actually going to go to the daily, because now we're doing a credit spread 101 here. All right. So if your thesis is that price is not going to go below 3,700, then you want to pick your strike at this point, right? Below 3,700. And that's number one. You also want to take into consideration how much the ATR is. So here, SPX is trading, has an ATR of 77, and the current price is 3,770. It means that you have the opportunity to move plus or minus 77. That's been the average over 14 days. You with me on the ATR? Yeah. But that's not the only thing that you can consider. The other thing that you can consider is that thinkorswim also gives you something called the implied volatility. So I'm looking at my screen over here, looking at the options chain for November 7, and I can see that the IV here is plus or minus 42. So if you don't know what this means that the expected movement for that expiration, specifically November 7, is plus or minus 42 points. Quite average, right? So plus or minus 42 points, it means that I can safely, once the market is open, you can't do this, you can't plan this when the market is not open. That number is relevant when the market is open, because right now we're not trading. But once the market is open, because it has this is volatility, this is a very subjective number. This volatility is not to be confused with the regular volatility. So regular volatility that is measured by VIX, that is not the same as the implied volatility, two different things, right? So you have to consider this when the market is open. Once it is open, then look at that number and see that we are plus or minus 42, and that should give you an idea where to sell. So assuming the market is open at this particular moment, then I would subtract roughly 50 points, because this is an estimation, right? So I'm allowed to estimate, and I can say 37.20 maybe. How about that? Let's see whether we can get any premium at 37.20. going to push vertical here, and I'm going to increase the number of strikes that I can see. And let's go 37.20. It looks like I can get about $1.05. Great. It's a go. Okay. That's an example. Now, this is deeper. This is a deeper discussion about credit spreads. So that just gives you an idea. There's more to it. Obviously, you want to get the full scoop. You want to get the full scoop. Let's see. Okay. Right. Nothing happening here in the chat. Nothing happening here in the chat.
If you're selling credit spread, isn't that 60 cents?
If I'm selling what?
You're doing
60 cents.
No, it's $1.05. The bid ask is 60 cents to 150. So thinkorswim will calculate what the median is, and that's the price that you can get.
Okay.
Yeah. So yeah, a lot of that's another I guess question that people just getting new to trading may be confused. They may just look at this number here by itself and not actually get the median. They might be afraid and say, well, this is too low. I really want to go up here. But remember, the closer that you get to the money, right now you're out of the money. Everything that is in the black section over here for PCS is out of the money. And that's ideal. You want to sell out of the money and ideally expire worthless out of the money, right? So to understand the real price of what you can potentially get, you need to either click on that bid, which says sell, and then you will get the median price, or do the math yourself. So 60 plus 150 is what? Let's pull out a calculator, right? So 1.5 plus 0.6 is $2.10. Is that about right, Claude?
Yep.
And divide that by 2 to get the average. That is 105. Now, you don't have to do that math in your head. Just let the system do it for you. Yeah.
Eddie, I have a question.
Hang on a quick second. So that was actually a good question, Cloud, there, because not everybody's on thinkorswim. Let's say you're in Canada, right? You've got two problems. One, it's cold. Second, you don't have thinkorswim, right? So because you don't have thinkorswim, you've got something else called interactive broker. Interactive broker does not have this kind of interface. And unfortunately, the trader has to do some complex calculations, like add two numbers together and divide them by 2 to get the average. Something as simple as that, the platform won't do it for you. So if you're using interactive brokers, then that is how you get to know the price that you need to put in for your bid. So that is specific to those people that don't have a platform that does it for them. So if you're in Canada, I think, I want to say in the UK, you don't have thinkorswim, but you probably have TradeStation. But I know for sure in Canada, they don't have. Okay, so Sam is saying that they don't have thinkorswim. So you have TradeStation, which kind of gives you, I think it does give you an average, a median price. In Canada and Africa, unless you have a US bank account, you do not have thinkorswim. Unless you set it up while you're here in the US and then you travel outside, then in that case, you're good. But let's go back here to your question. Who was that? Sorry about that. Go ahead.
Danielle.
Hey, Danielle.
Yeah, in this example, the leg you are selling is this 37.25.
Correct.
Right? I just want to make sure because I always get confused.
Yeah. And what Danielle is referring to here, she's referring to the principles of credit spread. She's asking which leg are we selling, which one are we buying? And again, thinkorswim will beautifully tell you which one is which. Here's how we know which one is which. Answer that for me, Claude.
Sorry about that.
No, it's all right. Tell them a little piece. I'll get back to them. Let's see. Well, thinkorswim will tell you, well, most platforms will actually tell you which one you're selling. there's this little symbol over here, the negative sign. That's the one that you're selling. In case they don't spell it out like here where it says sell and buy, the one that you're selling is always going to be properly listed here. But also, how do you know which one it is that you're selling? Again, I'm going to go to the interactive brokers example here because they don't have this interface. They need to know which one to sell, which one to buy. So if you're using interactive brokers or you're using a system that does not have that nice view where you can select spread vertical, you need to know which leg to sell. So let's talk about that. When you're doing a credit spread, the leg that you sell, the short leg, is the one closer to the current price, right? It's closer to the current price. And the one that you buy, your insurance leg, is the one further away from the current price. So let's talk about that. The current price is 3770. So when we think about the 3725, 3720, which number is closer to 3770? It's the 25, right? So what I will do is I will click on the 3725 and I am selling, right? I am selling the 3725. And now I want to do what? I want to buy. I want to buy the 3720. So what will I do? I'm going to push Control on my keyboard and I'm going to push the 3720 on the ask column. Bada bing, bada boom. I have just created a vertical spread in the right way. Now, is that cool or is that cool? Clear, but you've only got one answer, man. Cool.
Oh, it's cool. I've been watching all the videos, man. I'm trying to stay out there.
All right, cool. Just checking. Keep you on your toes. So if you don't have thinkorswim, that's the way to do it. You just have to know which one goes where. So that example was for that example was for doing a credit spread, a PCS. So remember, whether it's a PCS or a CCS, doesn't matter what, as long as it's a credit spread, the short leg, the one that you sell, is always going to be closer to the current price, right? The short leg. How close to the support and resistance levels do you enter? In other words, what's your trigger for entering the trade? I may not have a trigger, but I do try to stay as far away from the current price. So Marlon is asking, how close to the support and the resistance levels do I enter? And when I'm doing a spread, credit spread, which is selling for premium, I believe here the more important thing is how close are you to the current price? So here, the current price is 3770. Assuming that the market was open, then the 3720 would be game. That would be good, right? Because I'm far away. But if I switch over to the vertical view here, right now I'm on the single, and let's switch over to the vertical. I try to go about 6 deep, right? So if I'm counting from the current, this is at the money, right? So this line over here is at the money, and I can count 1, 2, 3, 4, 5, 6. That was 6 deep, and I would go on to the next one, 7. From there, I'm looking for premium. If I come closer than these, I'm adding risk. I'm adding a lot of risk. That makes sense? So let's also think about it. These are 5-point wide spreads. So every time I count 1, that's a 5-point wide spread, 10, 15, 20, 25, 30. I don't want to be 30 points close to the current price. There's a reason for that. There's a reason for that. Why is that? First off, you're not going to see much decay when you're that close to the current price. That's number one. If you're within 15 points, you're within striking distance of being in a max loss situation. So that's this point over here. You're only 15 points away. Premium is not decaying. Remember, this is a 0 DTE trade. Premium is not decaying for you at that point. But when you're 30 points plus away from the current price, you can see a tremendous amount of decay with just a $5 or $10 movement in the price away from you. Let's think about that last statement, price away from you. What I'm saying is that we're depending on one of the fundamentals about credit spreads or spreads in general is that as price moves away from the spread, the value of the spread decreases, right? With me on that? And as the price moves towards the spread, let's say you pick the 37.35, right? Go ahead and delete that. Say you pick the 37.35, 40.35. As price moves towards 37.40, what's happening, right? The value of this spread is increasing, right? From 140 to 145 and so on and so forth, right? But as price moves away from 37.40, meaning that the prices increases, the price of the underlying is going from 70 to 80 and 85 and so on and so forth, the value of the spread is decreasing. So that's why we want to be as far away. Remember, this strategy is sell high, buy low. I feel as though we've talked about credit spreads for too long over here. It's actually its own topic. So there's about 30 different things, and I've got about 15 different rules for credit spreads to do them the right way. This is things that they don't teach anywhere else, I think. But I've got tips and tricks that I can provide for you that you need to know when to do credit spreads. Do I sell verticals other than 0 DTE? Yes, I do. Yes, I do. I do debit spreads greater than DTE. I do 7, I do 30. Yep. That's Jackie asking. Doesn't that depend on the time of day you're selling? If at 8 a.m., 7 positions away is safe. If selling at 3 p.m., you get closer, right? If at 3 p.m., you don't need to be in the market. So let's rule that one out. Jackie, where's Jackie? She's still on? Yeah. At 3 p.m., you need to be at a golf course. You don't need to be in the market. Don't sell stuff at 3 o'clock in the morning, in the afternoon. Don't do that, right? So my thoughts on that, and my thoughts, it's opinion, and I'm opinionated. You already know that. So my opinion on that, when it comes to SPX, yes, I am opinionated. You want to sell in the morning, and you need to be out within an hour or 2 hours. If you're still in that trade 2 hours, something's going wrong, right? You're looking for a way out. And the reason you sell in the morning is obviously the volatility is higher in the morning. And as we go towards the middle of the day, the volatility reduces and you're able to get out. You've seen a reduction in the premium, right? If you wait until the evening, that's a whole different story, different strategy. I don't recommend it. You have zero time to recover or play defensive strategy. So no, don't do it in the afternoon. I don't encourage it. Don't do it. Do I trade in the afternoon now? Yeah, I do, but not spreads. So no. Okay. Oh, Marlon is actually refining his questions. We're here with regular calls. Marlon, how about you just get off mute? How about ask me the question? What do you mean? Let me understand this. What are you talking about? Got a mic? Where's Marlon? Is he in the house? He's not, doesn't have a mic. Okay, that's fine. All right. But I think I probably partially answered. I can't hear you. If you're talking, unless somebody else, can somebody else say something? Say hello.
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 Clip, I
Hello.
hear you. Okay, yeah. Yeah, but Marlon, we can't hear you, so I'm gonna have to pass on your question there. The second part of your question. Okay. Cool. All right, guys. Let's see. What other questions do we have? Do we have any other questions?
What we gonna cover on Monday? Can you give me a hint?
Yeah, I can give you a hint, but not here. That's in class, right?
Yeah.
Yeah, let's do that in class. I can answer offline. Cool.
I asked a question about Amazon.
Yeah. What about Amazon?
I was wondering how low you think the price will go, because I'm looking at when was that, Friday? it went down to like 89 or something. And I'm
88
trying to say it again.
$88.04 on Amazon.
Oh,
Test.
okay.
Test.
That's how low it went. Your question is what? How low I think it will go?
Yes, because I looked up like the weekly to have an idea, and it, I don't know. I didn't have a clear view. Like I didn't really know what to say because the numbers down there is so low.
Yeah.
I'm thinking to myself, is that gonna go down low like in the 70? I think 7, some right there, yeah. 81. Oh, this is on the daily. See, I couldn't see mine like that. Oh, trading view. That's right. Okay.
So when we are plotting the chart, I think your question is about plotting the chart, which we don't do too much here, but we can still address that question. You're asking what the next support level is, and the way we look for support is we're looking to see below today's candle, we're looking for the next lowest point, which happens to be approximately 81, right? Based on this formation over here. I had to zoom in real far, and it looks like back in back in March 2020, we experienced $81. So we're not very far off, about 9 points away from that. I don't trade Amazon that much anymore since it's so inexpensive. I used to love it when it was at 3,000 because I could do a lot of spreads on it. But if you was, to simply go with just the regular principles that we go on for peaks and valleys, support and resistance, then 81.40 seems to be the next support. And then beyond that, go ahead and so that seems to be your support level there, 81.30. Do I think it's going to go down there? I don't know. I have no idea. I haven't tracked this guy in a while, but that is how I would answer that question, by plotting the chart. Yeah.
Okay.
Cool.
Thank you.
Yeah. Cool. All
Eddie,
right.
can you give us a little bit more information around your course? Do you live trade? What's the format?
I'm sorry, the cost to do what?
What's the format of your course? Do you live trade? How is it set up?
I think I'm missing the second.
Can you hear me?
Yeah, you're a little muffled there, but the format of my
Sorry,
call?
probably my reception. So the format of your course, your class.
Oh, my class. Okay.
Yes.
Oh, good thing you're talking about my class.
And how is it set up? So, for example, someone who's a little bit more advanced, what do you do? Do you live trade?
Yep.
How do you give out these hints and tips and gems?
I tell you what, I've got 2 types of classes. I've got an advanced class, and I've got a beginner to advanced, right? And interesting that you should ask that, because let me share some details here about my upcoming bootcamp, right? So the bootcamp, as you can see, is starting next week. It's always hands-on. This one happens to be very, very concentrated, very high speed. It's actually going to go for 4 weeks. 4 weeks, and you're still going to have 8 sessions. My regular sessions are 8 once a week for 8 sessions, for 8 weeks rather. But this one is actually 4 weeks, so twice a week for 4 weeks, just because of the upcoming holidays, and also because it's very specialized. But what you're looking at right here on my screen is some of the things that we talk about, right? So week number 1, which is these 2 rows over here, we're going to be talking about, platform setup. Remember, this is a bootcamp. This is for people who coming in probably don't know anything about thinkorswim or their platform, or they're trying to spell the word stock or options. We're going to do all of that. Then I'm going to teach them how to plot charts the right way, how to plot a chart for options. You guys probably know how to plot a chart maybe for stock, but for options is a particular way What exactly is support and resistance? How do you know for sure that this is what support and resistance is? Trends, breakouts, formations, because these are the things that tell you when you get in, when you get out. You have to understand that. So if you're able to spot a trend, you're able to spot a breakout, you're able to get formations, these are the fundamentals of understanding and knowing buy low, sell high. What is the low? What is the high? That is it's super critical. If you don't know these, then you're just going to be guessing a whole lot, right? Then we're going to talk about the options chain, the usual Greeks, the delta, the theta, and all that kind of good stuff. We're talking about moneyness. This is not a word that I made up. Moneyness, right? At the money, in the money, out of the money, intrinsic and extrinsic values. All of those determine how you calculate your profit or expected profit. So nobody goes into a business to lose. In fact, most business plans, most good business plans will include a component of how you make money. Is that all right? I think that's right. Most people, when they do a business plan for any kind of business, they have to describe how you make money. And that is also true with options trading. You have to describe, you have to understand how you make money. You have to also understand how you lose money. So now you're talking about risk. So we figured that out, how to do that, the what, the where, the how, and all of that good stuff. Risk management, you guys know that, I don't go in without a stop loss, but that's not it. That's not all about risk management. There's a whole lot more. Then we're going to go about debit spreads. We're going to go about credit spreads. Here, we will talk about some advanced strategies, right? Not just the usual CCS and PCS, but we're going to talk about the iron flies. So this is where it starts getting advanced. And if you go to the advanced program, then you will see, let's go here to the advanced program here. That is part of the strategies that we talk about. But in this particular bootcamp, we're not going to be talking about all of them, but some of the others. So one of the other things that the bootcamp is going to have is the S&P, right? How to do that. How to do the S&P. Some people just do these. They're in the camp just to be able to do the S&P daily for cash. That's what they're looking for. And you can, this is where you make your hundreds or thousands every week. But the objective of the bootcamp is that everybody who goes into the bootcamp, by the 4th week, two things will be happening. Two things will be happening for the bootcamp is that you will have made your money back, or you will know how much you pay for the bootcamp. If somebody's asking how much is the bootcamp, it's $3,500. And you just sign up. The price is the same. I decided to keep it the same, but reduce the time frame for this particular bootcamp. It's the only one that I'm doing this year. The next bootcamp that I'm doing is for futures, right? Futures trading, those who do the MES and the ES. If you're trading that and you want to know how to do that, make money while other people are sleeping, you want to be in that futures class. Haven't announced the dates yet, but that's coming up. So Sam, to answer your question, that is a snapshot of the class in general. Most people are trying to get to this point, right? Most people are trying to get to this point, and they're also trying to get to the point where they understand risk management, because it's a concept that is ignored in a lot of places. A lot of places, I believe, they will teach you how to make the money, but not how to keep it. They might mention it, but I believe that if you have a very, very strategic way of protecting that and having a plan that actually helps you do that, so that it's not something that you do that gives you anxiety. If this is giving you anxiety, then you don't quit your job, right? Keep doing what you're doing, but because you don't want to create another job. Most people who come to these are trying to replace income, create a new income stream. They have an objective. Maybe they're trying to pay off something. I mean, it's basically a nice thing. It's a side hustle that eventually pays probably more than your main hustle. Does that help, Sam?
Yeah, sure. And
Okay.
and how do you help your students after the course?
After the course, so you have you join a community that that we call the alumni, right? The Options with Eddie alumni. So we've got people who I have coached and I have taught for more than 2 years. They're all in a community. We have Facebook, we have Telegram, we have weekly meetings, 2 weekly meetings with the alumni. The first and most important one is actually not the most important, but one of the important ones is that on Thursday mornings, we have what we call the Power Morning. Have you heard of that? So Power Morning is where we trade. We get together from 9 o'clock in the morning, that's 9 Eastern time, before the market opens, and we dissect what happened overnight. Okay, we plan based on what happened. We plan based on what we think is going to happen. We have no idea what's going to happen during the day. Nobody does, right? But we plot our charts. You all know that I plot my charts in the morning. I don't plot them in the evening. Too much happens overnight. So I plot my charts in the morning and plan my day based on what's happening at around 8:30, 9 o'clock in the morning. So I already gave you one of my tips is that, I take this snapshot. This is an important part of my plan of my trading day to understand what happens. Then we dissect, the futures to see what's going on, right? So that's Thursday morning. Goes on for about an hour and a half. Every Thursday morning. If you're an alumni and you buy the full course, that is included. Something else that's included is that on Thursday evenings, twice a month now, or every 2 weeks, we have what we call a power evening. That's where we teach the advanced strategies. So the reason I don't teach the advanced strategies in the regular class is, first and foremost, it takes a lot of time, number one. Number two is, if you're just starting these out, that is too much information, too fast, too quick, too soon, right? So you want dedicated sessions where we can talk about an advanced strategy and do it in a way that you've already experienced a lot. So just to give you an example, last week we were talking about stratos, right? Stratos are a strategy that you can use when you have no clue what's going on, right? But you want to take advantage of huge price action. You're going from a low volatility environment to a high volatility environment. I was about to bring that up when the person asked about volatility, but I realized it might be a little bit over the heads of some. But we talk about stratos, right? We also talk about strangos. So there's two words over there that may be confused or let's see. So there is, how I talked about it here. Maybe I did not mention it. I'm looking for it. Covered income. All right, well, it is there anyway, that those are things that we talk about, strangos and stratos. Back too far. Here we go. So we talk about advanced strategies, not just those stratos. We talk about iron flies. You guys already know about iron condors, real simple stuff. But we'll talk about the iron fly and the short butterfly. Those are two strategies that I think have value in your toolbox. Now, also remember that when you're options trader, you don't have to use all of these. You can know about them, but you don't have to use all of them. If you're using all of them, then maybe you're jumping around too much. You need something that you need maybe 2 or 3 strategies that you can zero in, that you can hone in on, become very, very proficient, which means that they are paying you well. And remember, once you figure out how to make $100, what do? Your job is now to multiply that and start scaling it up, right? Add a zero behind it, right? Add another digit in front, add another zero behind it, something like that. So, yes. Samuel, the answer is yes. Mm-hmm. All right. I'm a homeschool dad. I like that. Thank you. 18 from Friday, November 18. Where's my typo? I've got a typo in here.
Eddie, I have a quick question.
Yes.
So for the advanced classes for your student that took the classes with you, do they have access to the class
To this boot camp?
anytime? Yeah, no, not this boot camp, but the Thursday power evening.
Oh, absolutely. Yes. Yeah.
Okay.
You already have it.
I have not joined yet.
But you do have the invite from me, probably, right?
Yes.
Yeah.
I probably do. I have to just go in my emails.
Yeah. You pay me one time and that's all included. I don't nickel and dime. Yeah. Once you pay me, you get the full 9 years, the whole thing. The futures you have to pay again. So
Futures trading. Oh, I'm sorry. Is future trading like 24/7?
24/6, yes.
24/6. Got it.
Yeah. Futures market is closed on Saturday. Open Sunday night all the way to Friday evening. Okay.
So are the alum can we get in on the boot camp, or are we able to at least get the videos from some of those topics?
No. The boot camp is just like another class, only that it is shortened. Instead of 8 weeks, it is 4 weeks. But yes, can you get the videos? You will have access to some of the videos. So like if you've been in my class, you know that maybe the first couple of videos that are really, really private videos where the group is forming, getting to know each other, then those I never share. They're just for your group. But for topics that are advanced and where I believe that it will help the alumni, then I do make those videos available. So you don't have to be in the boot camp class. So, right. Cool. Samuel is asking, what are the prices? If you click on pricing and sign up, that is the price right there. Okay, pricing and sign up. That's how you sign up. Very easy sign up form, by the way. Just your name, your phone, choose the program. It's as simple as that. It's as simple as that. So, all right, good deal. Any other question? Hey, thanks for asking that question, son. Good marketing opportunity there for me. So thank you very much.
You're welcome.
Yeah. So
can you post the link?
Can I post the link? Yes. You mean in the chat? Yep. I will do that. I will do that. Done. It's a done deal. Options with Eddie. Options with Eddie. Or you can just Google me, and you guys know how I look like. So there's somebody else over there who calls himself Eddie and tries to be like me, but that's not me. So everybody's trying to be somebody, right?
Yeah.
Yeah. Everybody's trying to be somebody. Yeah. Cool. All right, guys. It is 12:53, and let me stop sharing here. See your faces. If you want to turn your camera on, that's cool too. So there we go. Awesome, guys. Hey, I love Saturdays, man. I love Saturdays. So and I love helping people. This is my passion. I think I can teach. So if you need help, I am willing to help. I'm willing to help. There's tons of ways that you can reach me. You can reach me on Facebook. Every once in a while, I show up over there on Facebook.
Hey, Eddie.
Telegram, I'm there as well. Somebody has a question?
Oh, yeah.
Hey, what's up, Samuel?
Yeah, Eddie, thank you very much for everything you have been doing.
Thank you.
Helping us. Yeah, thank you. It's greatly appreciated. But there is no the features price in the link.
Yeah. I haven't set a price and a date yet. It's more than likely going to be in the 3,500, 4,000 range. There's potential for you to make that back fairly soon. It's going to be in that price range, but I haven't. It will probably be a little less.
And you are not working on the payment installments too, right?
No, you have to do that with your bank.
It's just it's just one shot.
It is. Unfortunately, I don't have that. I don't have the luxury of that that feature there. So that's all I can say. Yeah, that's all I can say.
Okay,
Quick question.
Mm-hmm.
Will you be offering those class Monday to Friday too?
Will I be
feature
offering what?
classes? Will the feature classes be like a Monday to Friday thing?
They will follow the format that I have been having, which is once a week, or we could do twice a week. Again, I'm working on the schedule. So that is something that and I have a pilot class. I have a pilot class that I will be teaching once I start, and they get the benefit of not paying for it. So that class is already full. That class is already full, so I cannot invite anybody else to it. So the reason that I'm doing a pilot class is, you test something before you make it public, right? So once I refine that format, then I'll offer it, I think, once a week or twice a week. So we'll see how that works. So for now, we are still talking about options. Cool.
Eddie, you said you had some big announcement coming up. Was the futures class it?
I think so.
Okay.
Yep, that's it. Dora, you're reading my mind again.
If I could read your mind, I'd be rich now.
You should be. Yeah, I can't keep a secret. Yeah. All right, guys, it's been real. Saturday. It's almost 1 o'clock. Wow, we've been going for like what, 30 minutes now? Wow. All right, guys. If there are no more questions, I think I am about to drop the mic. I am about to call it a day here. So direct message here. Okay. You guys know how to reach me, right? Let me put in my email here. That way I can answer it to all. Everybody's asking, how do you reach me? And let me put in my email to info@optionswitheddie. Options with. There we go. So that is my email, info@optionswitheddie, or if you go to optionswitheddie.com, then you will learn how to sign up or get a hold of me. All right, sounds good. All right, thank you guys. Adios. I'm out.
All right, brother. Thank you.
All right.
Thanks,
Bye-bye.
Eddie.
Thanks,
Thank
Eddie.
you.
Thank you.
Adios, Heidi.
All right, have a good weekend.
Thank you. Adios.
Thank you.